Every single business you've ever bought something from, your coffee shop, your favorite clothing brand, even massive corporations, owes money right now. Not because they're failing, because owing money is actually a normal, healthy part of running a business. Today we're breaking down exactly what current liabilities are, why they matter, and how they show up on financial statements. Stick around, because by the end of this video, you'll understand something that even a lot of adults get wrong about how businesses handle their short-term debts. Here's what we're covering today: what current liabilities actually are, the most common types you'll see on a balance sheet, how accounts payable works in the real world, why accrued liabilities trip people up, and how notes payable differ from regular debt. Let's get into it. Section 1. What are current liabilities? Let's start with the basics. A liability is simply something a business owes, a legal obligation to pay someone else. Now, liabilities get divided into two categories on a balance sheet: current and long-term. Current liabilities are the ones a company expects to pay off within 1 year or within its normal operating cycle, whichever is longer. Think of it like your personal finances. If you have a credit card bill due next month, that's a current liability for you. Your 30-year mortgage? That's long-term. Businesses work the same way. Why does this distinction matter? Because lenders, investors, and managers use this information to judge whether a company can actually pay its short-term bills. There's even a formula called the current ratio, current assets divided by current liabilities, that tells you how well a company is positioned to cover what it owes in the short term. A ratio below 1 means the company might struggle to pay its bills. A healthy ratio gives confidence to everyone involved. So now you know what current liabilities are, but what are the specific types that actually show up on a balance sheet? That's where things get really interesting. Section 2. Accounts payable. Accounts payable is probably the most common current liability you'll encounter. Here's the simple version. When a business buys goods or services on credit, meaning they don't pay immediately, that amount owed goes into accounts payable. Imagine a restaurant that orders $500 worth of produce from a local farm. The farm delivers the vegetables, but gives the restaurant 30 days to pay. That $500 is now sitting in the restaurant's accounts payable until they write that check. This is incredibly common in business-to-business transactions. Companies extend credit to each other all the time because it helps everyone manage cash flow. The buyer gets to use the goods or services before paying, and the seller builds a relationship and usually gets paid in full, just a little later. From an accounting standpoint, the moment the goods are received, the liability is recorded, even before the cash goes out. This is a core principle called accrual accounting, which matches expenses to the period they actually occur in, not just when cash changes hands. Here's something worth thinking about. What happens when a company takes too long to pay its accounts payable? Does it help them or hurt them? Hold that thought, because the next concept actually connects directly to this idea. Section 3. Accrued liabilities. Accrued liabilities are expenses that a business has incurred but hasn't yet paid, and in many cases hasn't even received a bill for yet. This is where accounting gets a little more nuanced, but stick with me. The most common example is employee wages. Let's say your company pays employees every 2 weeks, and the accounting period ends in the middle of that pay cycle. Employees have worked for 7 days, but payday hasn't come yet. That money is owed. It's a real obligation. So the company records an accrued liability for wages payable right now, even though the cash won't leave the bank until next week. Other common accrued liabilities include interest payable on loans, taxes owed to the government, and utility bills that haven't arrived yet. All of these represent costs the company has benefited from, even if the bill hasn't landed on the desk. Why does this matter? Because without recording accrued liabilities, financial statements would be misleading. Expenses would look lower than they really are, and profits would look higher than they actually are. Accrued liabilities keep the numbers honest. Now, here's a question that trips up a lot of students. What's the difference between an accrued liability and a deferred revenue? They're almost opposites of each other, and that's exactly what we need to talk about next. Section 4. Unearned revenue and deferred revenue. Here's a current liability that surprises most people: money that a company has already received but hasn't earned yet. This is called unearned revenue or deferred revenue, and it sits on the liability side of the balance sheet. Think about a magazine subscription. You pay for 12 months upfront. The company has your cash, but they haven't delivered 11 of those months yet. They owe you something. Until they deliver on that promise, the payment is recorded as a liability, not revenue. Gift cards are another perfect example. When you buy a $50 gift card, the store records that as a liability because you haven't used it yet. They've taken your money, but they haven't provided goods or services in return. The moment you swipe that gift card, the liability decreases and revenue is recognized. This concept is critical for understanding how revenue recognition works. Businesses can't just count cash as income the moment it arrives. They have to actually earn it first. This prevents companies from inflating their revenue numbers by collecting lots of upfront payments. It also means that a company with a growing deferred revenue balance isn't necessarily doing poorly. It might actually mean business is booming and lots of customers are paying early. But here's what that growing balance eventually turns into. And understanding it changes how you read any balance sheet. Section 5. Notes payable and current portion of long-term debt. Our final type of current liability involves formal borrowing, specifically notes payable and what accountants call the current portion of long-term debt. A note payable is a written promise to repay a specific amount of money, usually with interest, by a specific date. Unlike accounts payable, which is informal trade credit, notes payable are formal legal documents. A business might take out a short-term bank loan to cover seasonal expenses, for example. That loan becomes a note payable on the balance sheet. Now here's the part that confuses a lot of people. What about long-term loans that are almost due? Say a company has a 5-year loan and it's now in the final year. The portion of that loan due within the next 12 months gets reclassified from long-term liabilities to current liabilities. It's called the current portion of long-term debt. This reclassification matters enormously. It changes how the balance sheet looks and how analysts assess the company's short-term financial health. A company might look stable on the surface but have a massive debt payment due in 6 months. Understanding current liabilities, all of them together, gives you a much clearer picture of whether a business is financially healthy or walking a tightrope. And that's your full breakdown of current liabilities. You now understand what they are, why accounts payable and accrued liabilities appear on statements, what deferred revenue really means, and how notes payable fit into the picture. If this video helped you, hit that like button. It seriously helps this channel grow. Subscribe if you want more accounting and finance concepts explained this clearly. And drop a comment below with any questions about current liabilities or any accounting topic you want covered next. I read every single one.